Greetings, everyone. Normally, I do this YouTube video on Employment Fridays, but today we're doing it midstream because the markets have been so difficult and the economic data so confusing, the market data so confusing. So I guess I should have introduced myself. Cathie Wood, Chief Investment Officer of Ark Invest. So today we have a very special guest. Her name is Nancy Lazar. She is the Chief Global Economist for Piper Sandler. I've known Nancy since 1982. We've both been in the business for a long time, and we've seen a lot of cycles and experienced a lot of markets. The reason I wanted to feature Nancy today is because of what I've been describing for the last few months on this YouTube channel. As you know, everyone looks at the same data. We all get the same data. The government puts it out. But different economists place different emphasis on certain variables at certain points in the cycle. And so we were watching 2 points of view based on the same data. One was we are back in the 70s environment. Inflation is baked into the cake. It's going to be very difficult to dislodge it. And we're probably in an environment where commodity prices, real estate, tangible assets generally are going to do much better than the financial markets. And so we were dealing with that scenario. And as you know, we were looking at data and actually more than a year ago anticipated a very different world. What we didn't anticipate, of course, was the extent and the length of time that we were going to see supply chain disruptions. And we certainly did not expect Russia's invasion of Ukraine. So those have been variables, we've had to work through in terms of our own thinking about the future. But we did come to the same conclusion that we were probably going to see more deflationary forces at the end of all of this than inflationary forces. And I believe that we are in the early stages of seeing that. Now, these are the early stages, but Nancy's view of the world, which she every week puts into charts that really help evoke what's going on. Her view of the world was closer to this, inflation is not embedded in the system at a rate much like the 70s.
Well, hi, Cathie. Thank you very much for asking me to be on this discussion with you today. Really, really appreciate it. And there's certainly a lot of very, very interesting things going on and some disturbing things, quite frankly, that are going on. And so there are many drivers of economic activity, but perhaps the two most important are both monetary and fiscal. Let's start out with the monetary side of the equation, which is page 2. And on the monetary side, the Federal Reserve is now raising interest rates. But actually, that's in a background of other central banks that have been raising rates already for over a year. We've counted over 180 central bank tightening moves. That is 180 interest rate increases over the past year. Not 180 central banks. There are many central banks have actually raised rates several times, which is now what our Federal Reserve is just starting to do. But we are a global economy, and it is global rates that drive our economy. And it's not the level of rates. Here you see global short rates are still very, very low. Many of you would think 1.8%. Gee, that's much lower than mortgage rates. What's wrong with that? But they've increased. It's the change in interest rates when you go from 0.8% to 1.8. It's that increase that changes behavior, that negatively impacts economic activity. And it doesn't happen immediately. It takes time. It takes roughly a year to change behavior. And so we are right now in a period where the economy is already starting to slow. You've certainly seen that with a lot of company news where their earnings are starting to get hit and overall economic activity is starting to slow. And now the Fed is starting to raise rates. That's very different when they last had a tightening cycle, which was back in 2016. they were raising rates into an accelerating economy, and that gave them a couple of years of higher interest rates without really disrupting the markets or economic momentum. That's not the case today. The economy is already slowing. Why is it already slowing? Again, because global central banks have been tightening for a year. You also have higher bond yields. You have higher oil prices. All those things lead growth, and they are now in the prospect of slowing economic activity. And now the Fed is stepping in and raising rates. We would argue they're late, and these higher interest rates that they're putting in place risk creating financial strains. And in turn, we don't think the Fed is going to be able to raise rates as much as they currently suggest, say around 200 basis points, because between now and then, there's going to be clear signs that the economy is slowing, and even inflationary pressures are going to come down. So we will get another rate hike, most likely in February and probably even in August. We're not so sure how aggressive the Fed's going to be able to be in the fourth quarter, because we think by then it's going to be pretty clear both growth and inflation are slowing pretty significantly.
Yeah, Nancy, I'm also struck. The Fed is really focused on the U.S., but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the US in isolation. We've already had 1 quarter of negative GDP, which most people brushed aside, saying, "Oh, that's a fluke." And I think that was a real number, and we should not dismiss it. So agree with you totally, Nancy.
And I would agree with you that Europe is already in a recession, to be sure. And don't forget the strength in the dollar. To the extent their currencies are weaker, the strength in the dollar is actually another disinflationary event here for the United States. So that just further increases the odds that we can see inflation slow pretty quickly.
Yeah.
Along with monetary.
I was just going to say, in the old days, in past cycles, many people thought that the dollar going up was the same as monetary tightening. It's a disinflationary force, and it's up 15% since the bottom, which is a huge increase for the dollar in such a short period of time, and really hurts emerging markets.
Absolutely. The dollar going up means that our imports from abroad are going to be cheaper and just makes it easier. And at the same time, the dollar going up further hurts corporate profits, and we're going to get to that. We're going to get to that in a minute. But the other major policy driver of the U.S. economy is classically fiscal policy. And if we go to the next slide, fiscal policy was really aggressive. As many of you know, either for small businesses or even big businesses, but also obviously individuals. And so government spending exploded, particularly in 2001, but started in 2000. So we had 2 years of very aggressive fiscal stimulus that went in directly into consumers' hands. And indeed, they were able to spend it we were able to spend it very quickly. But this is very different. Cathie, you mentioned the 60s and 70s. This is very different than the 60s and 70s. You had sustained increases in government spending, starting with guns and butter in the back half of the 60s. And then, unfortunately, Richard Nixon just basically took over the Fed and accelerated both government spending and money supply. Net for about 15 years, starting the back half of the 60s throughout the 70s. You had very aggressive, very rapid money supply growth and government spending on a sustained basis. And I'm using that word on purpose because that is not what we had in 2021. It was basically a whipsaw. I don't want to get into whether or not it was good or bad. I would argue that it was too much in March of 2021. The economy was already starting to heal. But nonetheless, it is what it is. And I agree with your point, Kathy, that this gave the consumer firepower to buy a lot of stuff. And then you had the port disruptions, both here and in China, shutting down of the ports. And that indeed created a shortage of goods. And so the consumers had a lot of money. They were buying a lot of stuff, but it wasn't all available, from bike prices to clothing prices. Obviously, used car prices rose very sharply because we had the money to actually spend. Well,
And
it's very, oh, go ahead.
I was just going to say the dotted line here
Yeah.
gives our viewers a sense of how restrictive spending is now, right?
No, exactly. That's what the dollar line is measuring. It's, first, it measured the surge, measured the stimulus, and you can see the orange line helped to drive overall economic activity up very, very, very strongly. But absolutely, to Kathy's point, the dotted line is now declining dramatically. Government spending is actually negative 20% this year. And from a fiscal perspective, from an economic headwind perspective, that in and of itself takes about 3 percentage points off of GDP this year. And so I would actually say this is at risk of creating a recession, potentially even more than the Fed, because this is happening right now. Many people are struggling because those stimulus checks are gone. And many people are struggling because obviously inflation has surged, and that's cut into real purchasing power. And a big reason is how quickly this government spending has gone from being very stimulative to be very restrictive. And a lot of that excess savings has been eaten up by inflation. And we're now, a lot of people are struggling as a result of this massive fiscal drag. So the Fed is tightening into a period of when fiscal policy is also even more of a headwind than currently the Fed is.
Yeah, and it strikes me that those who are listening will say, "Oh my gosh, this is terrible," and it is in one way. But one of the things we're focused on is what will get the Fed to stop tightening, or at least change its rhetoric. And I think as these forces put pressure on the economy, and you get companies like Walmart and Target reporting terrible numbers from 2 points of view. And I know Nancy is going to go into some of this, but their sales up 3% year over year, while inflation itself is up, if you looked at CPI, 8%. Now, they're not passing all of that through, but I am sure that they are passing more than 3% through. So that means their unit sales, their real sales, are declining on a year over year basis, while inventories are ballooning. And we think that those two factors, and now the Fed must be aware of them because Walmart's such a big, and Target's such big companies, those two factors probably have gotten the Fed thinking, my goodness, are we overdoing it here?